Okay, in this video, we're continuing our discussion of AUC Section 265 regarding communicating internal control deficiencies to management those charged with governance. In the last video, we discussed determining whether there are deficiencies in internal control. And now in this particular video, we're going to be talking about evaluating identified deficiencies in internal control. So we've identified some, and now we just need to evaluate them. And so it says that if we identify one or more deficiencies in internal control, then we should evaluate each deficiency and determine, based on the audit work that we performed, whether individually or in combination, these deficiencies constitute significant deficiencies or material weaknesses. Okay, we've got a couple terms in here that I don't think we've seen before in one of the prior videos, so we can go up to the definitions and see how these are defined. We have deficiency, significant deficiency, and material weakness. So let's go up to the definition section. Okay, so now we're in the definition section, and we have a definition of deficiency in internal control, significant deficiency, and also material weakness. So initially, let's take a look at what a deficiency in internal control is. And that is when the design or operation of a control does not allow management or employees in the normal course of performing their assigned functions to prevent or detect and correct misstatements on a timely basis. So we have to understand here that if we're not performing an integrated audit, we haven't tested these controls. So we don't know if the control is effective or not. However, as part of our planning procedures, at least, in our walkthroughs that we've performed, we understand the design and the operation of the control. So from there, we are making a determination of whether the design and operation are appropriate for preventing, detecting, or correcting misstatements on a timely basis. So a deficiency in design exists when the control necessary to meet the control objective is missing, or an existing control is not properly designed, so that even if the control operates as designed, the control objective would not be met. So if going through our audit procedures, we determine that this control is not designed appropriately, for instance, it's missing, or it doesn't meet the objective that it should, then we might say there's a deficiency in that control. Also, we could find a deficiency in operation, and that's when the control doesn't operate as designed. So maybe it was designed appropriately, but people aren't performing the control appropriately. So for instance, the control owner doesn't have the authority or competence to perform that control effectively. So to reiterate, we're not finding deficiencies based on whether the control is effective, but rather that the control is properly designed and that it's operating as designed. So now that we understand deficiency in internal control, there are basically two types. There's a significant deficiency and then a material weakness. And so a significant deficiency is, as it says, it's significant, but a material weakness is worse. And we'll see that in the definitions as follows. But starting with the significant deficiency, it's a deficiency that we just defined, or a combination of deficiencies in internal control over financial reporting that is less severe than a material weakness, which we'll get to, but is important enough to merit attention by those charged with governance. So say we find a control that's not designed properly, and it's likely to cause, or it's likely to not catch or correct misstatements, material misstatements, then we might define that as a significant deficiency. And regarding material weaknesses, that's a deficiency or a combination of deficiencies that we defined here, internal control or financial reporting, such that there's a reasonable possibility that a material misstatement of the entity's financial statements will not be prevented or detected and corrected on a timely basis. So what does it mean when there is a reasonable possibility? That would be when the likelihood of an event occurring, and in this case, that a material misstatement of the financial statements will not be prevented or detected and corrected. So that would be reasonably possible when, or it would have a reasonable possibility when it's either reasonably possible or probable. Reasonably possible would be the chance of a misstatement not being prevented or corrected. It's more than remote, but less than likely. And probable would be that material misstatement would not be prevented or detected, and that would be likely to occur. So either more remote, or rather it's more than remote. Basically any deficiency in internal control such that the possibility of a material misstatement occurring and not being prevented or detected is more than remote. The possibility of that is more than remote, then we might call it a material weakness. And that's really a low bar, a low threshold to have to meet to be a material weakness. But in practice, you'll use your professional judgment to decide which of these is the appropriate one when you notice a deficiency. So let's continue on with the requirements below and see what we need to do with this newfound knowledge of these terms. Okay, so we're back down into the requirements. So now that we understand the definitions of these terms, let's go through this first one again. It says the auditor has identified one or more deficiencies in internal control. The auditor should evaluate each deficiency to determine on the basis of the audit work performed, whether individually or in combination, they constitute significant deficiencies or material weaknesses. So we basically need to, whatever deficiencies in internal control that we found, we need to split them up into just a deficiency or a significant deficiency or material weakness, and we can classify them into those groups. So next, if we initially determine that a deficiency or combination of deficiencies in internal control is not a material weakness, then we should consider whether prudent officials having knowledge of the same facts and circumstances would likely reach the same conclusion. So this makes us look at it from an unbiased perspective, as if someone outside of the audit who knows what about the control in the audit, what would they conclude is the appropriate classification, significant deficiency or material weakness. So we've got some explanatory material here, A5 through A14. So let's go down to those particular sections. Okay, so now we're down here in the explanatory material, where they get some more color and information on evaluating the deficiencies that we've found. So first it says that the severity of a deficiency, or a combination of deficiencies in internal control, depends not only on whether a misstatement has actually occurred, but also on these two things. The magnitude of the potential misstatement resulting from the deficiency, and whether there is a reasonable possibility that the entity's controls will fail to prevent or detect and correct a misstatement of an account balance or a disclosure. So not only if it doesn't only have to be a deficiency if a misstatement has actually occurred, but a potential misstatement. So if this internal controls design or operations makes it possible that there could be a misstatement, then that might warrant a deficiency. And then next we have to decide, would that potential misstatement be material to the financial statements? And that would tell us whether there's a significant deficiency or material weakness in place. And so then those two may exist even though the auditor has not identified misstatements during the audit. So even if there are no misstatements in the audit, we could still have potential misstatements in the future. So we would need to let them know about those deficiencies in internal control. So next it tells us a little bit about determining the magnitude of a potential misstatement. And that might be determined by the financial statement amounts or total of transactions exposed to the deficiency. So for instance, if the deficiency were to be in place, what might be the amount that ends up being misstated? And also the volume of activity in the class of transactions where the account balance is exposed to deficiency. So if there's a lot of transactions running through this process where the internal control is deficient, then there might be a chance for a pretty large magnitude misstatement, just because there's a lot of activity and transactions running through that process. And this next one reminds us, and it's fairly obvious, that overstatements, or the maximum of an overstatement, would be the amount that is actually recorded. So for instance, if accounts receivable is $1 million, then it's not going to be overstated by more than $1 million, because that's where it would be zero, and it can't be below zero. But on the other side, understatements could be much, much larger than the recorded amount. So we have to be careful in our audits when we're using materiality as thresholds, because the risk of understatements would produce much larger values than the recorded amount, potentially. And so we can't argue that an account is immaterial if there's a chance that there is an understatement. So continuing on here, they have some risk factors that affect whether there is a reasonable possibility that a deficiency in internal control will result in a misstatement of an account balance or disclosure. And the factors include, but are not limited to, the following. Remember, in order for it to be a material weakness, it has to be, the deficiency has to reasonably possibly not prevent, detect, or correct a material misstatement. So here's a lot of factors that will help us understand whether it's reasonably possible that would be the case. And so it would be the nature of the financial statement classes of transactions. We might consider those. We might consider the cause and frequency of exceptions detected as a result of deficiencies, the susceptibility of the related asset or liability to loss or fraud. Several others. Here we have the importance of the controls in the financial reporting process. For example, oversight of management, over significant transactions with related parties, so on and so forth. So we might consider each of these factors when we're deciding if there's a reasonably possible chance that misstatements material misstatements might not be detected, prevented, or corrected. And continuing with the topic of reasonable possibility, it says here the evaluation of whether deficiency in internal control prevents a reasonable possibility of misstatement may be made without quantifying the probability of occurrence as a specific percentage or range. So we don't necessarily have to think to ourselves, well, there's a 20% chance that this account might be materially misstated due to this deficiency. We can use a lot of different factors and understandings, like some of the ones that we discussed here. And also they make note here that a small misstatement is probably more likely than a large misstatement. So that would mean the probability of the small misstatement is greater than the probability of the large misstatement. So there might be a lot of cases where it's pretty likely that the account will be misstated, but it's very unlikely that the account will be materially misstated as a result of that deficiency. And next, controls may be designed to operate individually or in combination to effectively prevent, detect, and correct misstatement. And as a result, a significant deficiency in internal control on its own may not be sufficiently important to constitute a significant deficiency or material weakness, but if it's combined with other deficiencies affecting the same transactions, account class, and so forth, then the combination of those deficiencies may increase the risk of material misstatement to such an extent that these in combination may be a significant deficiency or material weakness. So they gave an example here of the accounts receivable might contain automated and manual controls to prevent, detect, and correct misstatements. But and so if one of those is sufficient, it may not be as big of a deal because the other one would maybe compensate. But if both of these are deficient, then it would possibly create a reasonable possibility of material misstatement. So this should be communicated. And so indicators of material weaknesses in internal control include the following bullet points here. Number one, indication of fraud, whether or not material, on the part of the senior management. Because, of course, this means that there might be override of controls and such to the point that it's pervasive across all of the financial statements. So there may be a material weakness there that there's a risk that all accounts might be reasonably possible for the accounts to be materially misstated as a result of this fraud and the management override likelihood. Also, indicators of material weaknesses would be a restatement of previously issued financial statements to reflect the correction of a material misstatement due to fraud or error. So if we had to restate the prior period's financial statements, that might mean that there aren't good controls in place to ensure the accuracy of the financial statements. Also, indicator of material weakness might be an identification by the auditor of a material misstatement of the financial statements under audit, and circumstances that indicate that the misstatement would not have been detected and corrected by the entity's internal control. So if we've got some material misstatements as a result of our audit procedures, and we note that there wasn't a control in place that's properly designed to catch that misstatement, or it wasn't operating effectively, then there's a more than a remote chance that that misstatement would not have been detected and corrected. And obviously, since we had that misstatement in our audit, then it certainly was not detected and corrected. So there's a reason to believe there is something deficient in their internal controls. Next, another indicator of material weakness might be ineffective oversight of the entity's financial reporting and internal control by those charged with governance. So if the board or the owner operator or whoever is in charge of the governance of the entity does not actively participate in the financial reporting process or actively monitor the accounting group, then there might be a chance for material weakness there.